Good evening and a very warm welcome to this Edelweiss webinar. My name is Varun Sanan and I'm from the Edelweiss sales team. I'm the Zonal head for Mumbai. As you are all aware that it's been our constant endeavor at Edelweiss to bring you up to speed with what's happening in the financial markets and create new and innovative products for investors and distributors to advise their clients. Taking this a step further today, we will be discussing a few equity index funds. With me, we have our most eloquent CEO, Radhika Gupta, who has spearheaded the Edelweiss asset management into one of the most relevant asset managers today. And we manage over 1 lakh crore of AUM. Hi, Radhika. Welcome to this webinar today.
Thank you, Varun, and thank you to all our partners who I can see have joined in large numbers on a virtual call on Friday evening to understand this topic. So really hope that the next 45 minutes or so of conversation adds a lot of value to you, and that if you have any questions also we're able to answer them.
Sure. Radhika, let me start with a few very relevant and pertinent questions for investors and advisors to understand that what exactly are index funds and what do they offer their clients in terms of investment options?
So I think it's a good question, and while it's a simple question, it's important to start with the basics. I consider index funds as starter funds. They are like an equity or debt mutual fund, but instead of a fund manager making active decisions about which stock in an equity fund to buy and sell, all you do is buy an index. The index could be an index like the Large Cap Index, which comprises the top 50 companies, a mid-cap index, which comprises the next 150 companies. It could be a fixed income index. It could be a gold index. But essentially, it is a rule-based index where the rules are usually very simple. And the job of the fund house is to replicate the index in entirety without taking any active decisions. This is why such funds are called passively managed.
So are index funds very popular overseas? And if they are, do you think that there are similar trends that are playing out in India as well?
So, of course, index funds and ETFs, the whole category of passive funds, has become extremely popular overseas. Indexing has sort of become a revolution. And, because I forgot to mention this point in your last question, what is the value proposition, or what is it that has made indexing so popular? I think multiple things. One is simplicity. I truly believe that while there's a lot of conversation about alpha and performance, index funds were never about that. It was just a simple way to get started. In a universe where there are often so many funds to choose from. I mean, in equity and debt funds, there are so many funds and so many categories to choose from. Just choosing the index sometimes is a very convenient thing. I think the second element that people like is the simplicity, the fact that it is rule-based. And there is a consistent approach. So the good thing about rules is that they are rules and rules don't change. For a customer, it is very easy. It requires less time and effort to track and to renew. You're just following the indices. Often they tend to be very basic indices. I think the fourth thing is, because index funds are rule-based, there's no element of emotion. So companies don't get emotional about stocks. They add good performers, eliminate bad ones on rebalance. You don't have to think about that. Since index funds represent the market and there's no active management, of course, costs tend to be a little lower in index funds. But I do believe the primary reason for index funds popularity is simplicity and consistency. As far as to your second question, Varun, whether this trend will grow in India, I do think it will grow in India. We are the market leaders in debt passive, for instance, in debt index funds. And that's been a category that's been one of the fastest growing categories in the last 1.5 years. Even equity index funds, if you see the number of folios coming into equity index funds, I think that is just zoomed. If you look at the new crop of investors that is coming into market, for instance, millennial investors, I know CAMS put out a very interesting report on millennial investors a few days ago. They tend to be funds of choice even for this category of investors. So I think there is an appeal that they have, and this movement is growing. Also, the variety available in index funds is just getting better and better.
Fantastic. So Radhika, coming down a little down the funnel. Now, you mentioned that index funds are getting very, very popular. When I look at the data out in the West, they're almost 50% of all assets are controlled by ETFs and index funds. And I'm sure they will require a level of expertise by the asset manager. They're very different from actively managed funds where there is an investment team which is taking stock calls and buying stocks basis, the merits, etc. How do you think Edelweiss and what capabilities does Edelweiss have to manage the index funds? And have we shown in the past that these capabilities have come to fore?
So I think index funds require two kinds of capability. One is the product ideation capability, and second is the manufacturing capability. I'll take the second one first. So I think the ability to manage large scale index funds and passive products at scale is something that we've demonstrated in a very big way with perhaps one of the most challenging classes of index funds, and that is debt index funds. We brought the first corporate bond ETF to the market, that is Bharat Bond. In fact, the first tranche of it matured in 2023, and we showed in the maturity of that tranche that we managed to do a category like fixed income, a first to market fund without material tracking difference. So I think that shows you that we were the first to launch debt index funds in the market. So I think the capability to manage index funds and ETFs and to do it at serious scale. Today, we are 50% of the debt passive market. I don't think any AMC is that size in any other category, has been shown. Even on the equity side, a lot of people forget that we run a very large, hybrid business. And those are essentially rule-driven funds, and our hybrid funds are sort of consistently best in class. The same team looks after our equity index funds. So we have the capability to do passive investing at scale. We have the capability to run rule-based funds at scale. And I think we have the product capability to ideate. I think Edelweiss is an AMC that all of you tell us that has been known for industry first ideas, for innovation in this space. And that's what some of our index funds are also going to offer.
So in my opening comments, I'd mentioned that Edelweiss has brought first of its kind innovative products to the markets in the last 4-5 years with a lot of products that are very, very innovative. So Radhika mentioned about the entire debt passive space where we started off with Bharat Bond and we were pioneers in the target maturity space. But also on the equity index side, we launched a very differentiated strategy, which is on the healthcare side, which is the healthcare index fund, which also has some bit of international exposure, which we run with MSCI. In terms of other products, we launched a commodity index fund, which is a gold and silver 50-50 index fund. And we've got a lot more that we will speak about today. So Radhika, of a lot of these funds that we have, what do you think are a couple of very, very innovative ideas that investors and advisors should look at from Edelweiss's stable?
Okay, so I think the first one I'm going to talk about two today. The first one I'm going to talk about is very close to my heart because I truly believe it's such a simple product. But it's like अगर पहला इंडेक्स फंड या पहला फंड किसी का होना चाहिए तो ये होना चाहिए. It's and the testament to that is the first mutual fund I started in SIP for my son is this one. It is the large and mid cap index fund. So that's the first one I'm going to talk about.
So Radhika, you mentioned about the large and mid cap index fund. What exactly is this fund and what does it set out to do?
So I'll tell you the technical construct and then I'll tell you the reason I think this is exciting. So if you look at the large and mid cap index fund, and I'm sure you're pulling up the data, it does something very simple. It gives you exposure to two categories of company. One is large cap, which is the top 100 stocks by market cap. The second is mid cap, which is the top next 150 stocks by market cap. And it gives you this exposure in a 50-50 construct. Thereby, you have exposure to the top 250 companies of the Indian economy. As I said, I picked this for, my son, because I thought over 15, 18 years, all he needs is that India will grow. He'll get exposure, not just to the stability of large caps, but to the upside and wealth creation that comes from mid caps, and he'll get it in equal quantum. So I think it's a great starter fund. One of the unique things that I do want to stress on is this 50-50 rebalancing. When you buy a large cap fund, it's 80% large cap. When you buy a flexi cap fund, it is often 70% large cap. When you buy a large and mid cap fund, it is also often 70% large cap, because these funds look at the index, they're market cap weighted. Here, large and mid cap are equally weighted, and that is extremely powerful. So I think that is what makes this, construct powerful. Of course, this index, is reviewed on a half-yearly basis, and then there's a rebalancing that happens.
Sure. So from what I understand is it is an index that has 50% allocation to the large cap stocks, which are the top 100 stocks of the Indian stock market by their market capitalization. And the next 50% is in the 101 to the 250th stock, which are classified as mid-cap stocks. And these are the next level of stocks or the next level of large companies in the Indian stock markets. Now, this rebalancing is done on a periodic basis where, if the large cap weight increases, say, from 50% to 60%, in the next rebalancing, it comes down back to 50%. So, Radhika, two questions here. How does this help investors and in terms of, their weights coming back? And where do you see, this product kind of fitting into a client's portfolio? What does it actually do for a client, to have a product like this in his portfolio?
So as I said, I think this solves multiple problems for a customer portfolio, and as you're pulling through the data, I will talk about that. I think it's a great starter fund for a customer in their portfolio. Now, very often when customers are starting and looking for this kind of fund, they look at so many categories. They look at large and mid cap, they look at flexi cap, they look at large cap. Then within the categories, you have to decide which fund to choose. I think this eliminates that problem. Now, to the audience here, I think if you look at the data that Varun has, this is the year-on-year ranks of the top 10 flexi cap funds since 2016. What do all of us do, or what do most investors do when they choose a fund? They look at the best performing fund of last year. I always say the last 1 year return is the worst statistic in our industry, and they jump into that. But if you just look at Fund A in this analysis, Varun, if you can put your laser pointer there, Fund A was the best performing fund in 2016. But look at what happened to it in 2017. And, active funds have different styles and philosophies, and it's hard to pick which is the best performing. So investors struggle with that. I think this just makes a very important core portfolio choice simple for a customer. The second thing that I think this fund does well, and Varun, if you can pull up the second slide here, this. The second thing that I think this fund does well is sectoral concentration. Now, if you look at our large cap indices, they are almost overly reliant on a couple of sectors. Financials, as you know, often tends to be 35 to 40% of the benchmark. IT and IT services tends to be a large part of the benchmark. Large companies like Reliance Industries dominate. So, 60% of your benchmark tends to be a few sectors. And what you see in this chart on the gray is the sectoral concentration of the large cap index. Now, what you see in blue is the sectoral concentration of the large and mid cap index that we are talking about. As you can see, it's a lot less concentrated. So financials is a significantly smaller portion, as is IT and oil and gas, and it makes way for some of the more interesting sectors, whether it's capital goods, construction, chemicals, etc. So it's a much broader index in terms of sectoral representation. I truly think it represents the Indian economy in completeness without a market cap bias.
Absolutely, Radhika. I completely agree. In fact, what we've seen in the past is that, think about it, over decades, the sectors keep changing. So you will have a period where IT will be a big overweight on the index, and then 10 years down the line, probably banking and financial services becomes the largest part. And what this does is it gives you starter exposure to a lot of these up and coming sectors, which you otherwise wouldn't have got. So sectors like construction, services, textiles, media and entertainment, a lot of these would be part of the portfolio in the large and mid cap index fund. And, I completely agree with Radhika's point that it does regular rebalancing, makes it a very true to label product. It has less concentration, but I think it's also relevant to look at the performance specs of what this fund has done. Now, if we look at the performance specs of the large and mid cap index compared to the Nifty 500 and the Nifty 200, Nifty 500, you will know, is an index of the top 500 stocks, and the Nifty 200 is the index of the top 200 stocks. And if you take a look at long-term performance, 15 years and 10 years, what you will realize is this index is very, very efficient. It plays out the winners of the next few years and weeds out the losers that are companies or businesses that are going down. And that is why we think this is a very, very good, compelling starting option for investors who want to look at investing in large and mid cap or even large cap as a category. Coming to some more data, a lot of investors look at systematic investment plan or SIPs to invest for periodic investments. And if you take a look at the kind of returns that have come out from the large and mid cap index fund, and what we've also plotted for you is a comparison that if you were actually investing in a large and mid cap fund, what is the category average versus the large and mid cap index as such? And what you will see is consistently over shorter, medium, and long time horizons. Let's look at a 10-year SIP return. A 10-year SIP return is about 14.5 compared to a 13.5 for a large and mid cap category average. What you also have is absolute numbers that if you would have invested 12 lakhs over the last 10 years through a 10,000 rupee SIP per month, that would have grown to about 25.5 lakhs. So clearly you have a product that over a long time period has dished out very, very consistent and great returns. So Radhika, by the looks of all of this, this looks like a great startup fund for an investor who's starting out in his investment journey. But also from an advisor's standpoint, does it have any benefits in terms of taxation, etc., for an advisor to suggest this product?
Yes, I think one of the, outside of its simplicity, one of the benefits for advisors is the fact that, you can today buy Nifty 100 and midcap 150 separately. A lot of us come to that. But what you'll have to do is constantly rebalance. So hypothetically, if you bought 50-50 to start with and midcaps ran up and they became 75% of your portfolio versus large caps, you probably would want to rebalance that because you would be uncomfortable as an advisor holding 75% in mid caps. Now, if you rebalance that, there is a tax incidence on the client. And, I was talking to an advisor today morning, Varun, we were having that conversation. A lot of people don't like to pay tax, and that's why a lot of people don't rebalance. So this becomes a structure that auto rebalances without emotion, one, and without the tax incidence. So for a client, it's very efficient, and for an advisor, it's very easy.
Sure, Radhika, that makes absolute sense. So Radhika, moving on, what we've looked at from the large and mid cap index fund, it looks a very compelling solution. But we also mentioned that there is another product that we'd like to speak about today. Which one is that, and what do you think that product is?
So I think if this, of the two products I was going to talk about, if this is a simpler core equity kind of solution, this one is, I think, a very innovative solution in the mid-cap space. And, the mid-cap space is something I can talk about, for a long time, because I truly think Indian mid-caps are perhaps the most exciting segment of our market. But this is the Nifty Mid-Cap Momentum Index Fund. So people have heard of smart beta funds, funds that focus on themes or ideas, whether it's value or quality or momentum. This is one of those. And it's a fund that concentrates on companies that are showing performance momentum in the mid-cap space. That's what it is.
So Radhika, when you say momentum, what does it actually mean? If I'm a layman and I want to understand what momentum is, how would you explain that to a 5-year-old?
So I'll tell you how. Agar sports ka match ho raha hai, if there is a cricket match, and sometimes we say a player is in form, momentum means a stock is in form. That's exactly what momentum means. Now, when do you say a player is in form, Varun? Usually when the player is in form, he's been hitting sixes, he's been having a good run through the last few matches. That's what momentum is. A stock is in form when it's been having a good run. Now, there are different tenures of being in form. I mean, you can be in form over 5 years and you can be in form over 3 months. The same thing applies to stocks. So they can be 6-month momentum, they can be 12-month momentum, they can be 1-month momentum. But momentum means things that have done well recently. Inform usually means you're delivering in the context of stocks. It's stocks that have had price performance, usually because earnings have turned around for the stock, the market has kind of discovered the stock, and that's why momentum picks up in the stock.
So Radhika, clearly the example was very, very hard hitting. But if I have to take it a step further for people to understand how the index is really constructed, what are the nitty gritties of the index construction and how is it done, and what is the rebalancing methodology?
And I'll simplify this a little bit because the name is a little long. Edelweiss Nifty 50 Midcap Momentum 150 Index. So let me try and simplify this just a tad bit. So you're looking at the universe of the top 150 midcap companies. That's what comprises midcaps. The first 100, as we talked about in the previous fund, are large cap. The next 150 are midcap. So that's what you're looking at. Now you're looking at all these stocks and you're checking their momentum. You're looking at their 6-month numbers and you're looking at their 12-month numbers. So how well has the stock done in 6 months? How well has the stock done in 12 months? And then you are ranking each stock. And after you do that, you are adjusting and building the portfolio basis market cap. One of the very nice things in this fund that's important to be highlighted is the weight to any stock is capped at 5%. That's one of the reasons I really like this index, because it makes sure that it's not a very concentrated index. So the weight to each stock is capped at 5%. Weight to non-F&O stocks is 15%. And again, this index is rebalanced on a semi-annual basis. So that's the index.
So from what I can make out and what I can decipher is the fact that the index is basis 6 months and 12 months price performance for stocks that are doing exceedingly well. And the example that you mentioned, if a player is in form. So what we try and do is we don't try and take 1 week or 1 month or 3 month, very short period of form. We give equal weightage to 6 months and 12 months. And that tells you that the stock is in momentum because pure play fundamentals have improved for the company. And then we have some risk parameters that we get into existence, which is 5% is the weight capped for a particular stock, and 15% is the weight of capped for cumulative weight capped for non-F&O, non-derivative stocks. So that what that will do is try and get the volatility a little low for the fund. Now, Radhika, if I have to, jump into another question here, which is, when I look at the trailing returns of this fund since it is a mid-cap strategy, we tend to invest for a longer period of time. But if I have to look at 5 years and 10 years of performance, what I clearly see is the Nifty 150 Momentum 50 mid-cap fund versus the 150 TRI index and the category average for mid-cap funds. This has outperformed both of them, and consistently so. What would you attribute to this? Can you attribute a couple of reasons that why this performance has been so stellar across all time periods?
So I think what works for this construct is momentum actually. So India is a market where momentum works well, and really where momentum is truly powerful is actually the mid-cap segment. I know there are lots of momentum products and constructs out there, but really where momentum works very powerfully is a segment like mid-cap. You have to realize, see, these companies at some point are a little less discovered, and then they sort of have a catalyst, they have an earnings breakout. A bunch of institutional investors and investor community start discovering them, they pick them up, and then you see momentum in the stock. And there are many individual stock examples. Then one can look through history. So that's the primary reason that momentum does extremely well in mid caps. The other thing that I like about this fund that enables it to do well versus the benchmark is it's fast. It picks up winners quickly. Often, an active fund will take time because a manager, rightly so, will want to see multiple cycles of earnings before picking up a stock. By that time, the stock may be expensive. It also dumps stocks quickly. And that is why, and I'm sure we're going to talk about drawdowns, but that's actually why it doesn't do badly on the downside as well.
Sure, makes absolute sense, Radhika. In fact, when I go into rolling returns data, and let's focus on the 5-year rolling returns. And rolling returns, for all of you who know what rolling returns are, and for some of you who don't, are returns plotted for every 5-year investment over multiple cycles. And this data is plotted from April 2010. So the first observation would have been taken in April 2005. So that is how 5-year rolling returns work. But when I look at the rolling return data, what I clearly see is, and let's focus on the average return that an investor would have got if they would have invested in a strategy like this over the last many years on a 5-year rolling basis is a 21% CAGR. If investors had invested in a mid-cap plain vanilla index, that CAGR would be about 14% compounded annualized growth rate. And in the average mid-cap fund, actively managed funds, that would have been about 15%. We are not trying to give any estimate numbers here, but what we're trying to do is show you from past data that there is a very high likelihood for investors to catch a higher alpha in a momentum strategy compared to most actively managed funds. In fact, even if you look at maximum returns, what you will see is maximum returns are significantly higher. Maximum returns would mean investor who's captured this at its best, which is come right at the bottom and exited right at the peak. And for an investor like that, a maximum return of 37% compared to an average 28-29% from the index and category average for active funds. But what's very, very interesting, and this is where, Radhika, I want to bring you back in. When I say momentum, a couple of things come into my mind. One is obviously it will be highly volatile. The second is that when markets head south or when markets enter a correction mode, a strategy like this would tend to highly underperform most funds or even the index. Does that statement hold true?
It doesn't. And when we looked at this index for the first time, this was my first concern because one associates with momentum with all the things you say. Now, fundamentally, what's good about this index is two things. One, it exits losers very quickly. Secondly, I think we underestimate the impact of the fact that there is a 5% cap and a 15% cap on non-FNO stocks. So a lot of those names, are automatically capped out. Now, just look at some of the data that's really interesting. And for this analysis, I think it's only important to focus on the bear phase because that's really what we're worried about. So if you look at the COVID crisis, actually, the mid-cap momentum fund actually marginally outperformed the Nifty mid-cap TRI. If you looked at the major crisis that happened in 2010, again, the fund actually fell significantly less. And if you look at 2008, it was actually in line. When I saw this data, I think this was actually the data that convinced me that we should launch the fund. And as I said, the fundamental premises for the data is that it's able to dynamically move its portfolios and cut losses very quickly. And the other thing is, I don't know if you have the standard deviation data here, Varun, but if you look at the standard deviation of this index, which is a measure of the risk of the index, for those who understand it, it's in the exact same zip code as the Nifty mid-cap TRI or an actively managed fund.
In fact, Radhika, I pulled out some data against the best performing funds in the industry to see what the standard deviation or volatility of this index was. The standard deviation for most actively managed funds is about 21.5. The mid-cap TRI 150 index, the standard deviation is close to 23. And this fund is about 22. So the standard deviation is actually in line with most actively managed funds. So if you have a product that has volatility as much as most active funds, you have a product that, during bear phases gives you better downside protection or lesser drawdowns, and a product that during, market up cycles captures better returns. I clearly think that we've got a winner on the table. In fact, if I have to go into SIP returns as well, because, we're big proponents of investments through SIPs, and especially in, markets where things are turbulent, there are a lot of news flow driven events that happen. But if you look at SIP flows across time periods, you look at an SIP flow over a 15-year period, the funds delivered about a 22% return. You look at the SIP returns over a 10-year period, it's about 21%. And compare that to the best in class mid-cap actively managed funds, it's just blown the lights out. So, clearly you have a strategy that is actually a smart beta strategy, which is what Radhika started the, fund introduction with. So I think, we've covered a lot of ground. What I would call for now is all the advisors who've got questions on this call can start typing in their questions and send us their questions. And if you've got feedback, please share that as well, and we'd be happy to answer them.
Yes, and as Varun is taking questions, I'd also encourage you to refer to edelweissmf.com. We've got a section that I think maybe people need to visit more. It's called Passive Equity Funds. And each of these funds, including the two funds that we've discussed, have a very detailed page where you can see some of this data. You can see this presentation. You'll also see data on other index funds of ours, like the healthcare one that Varun mentioned, small cap, and many others that we have in our basket. But these were sort of the two very interesting solutions that we thought it would be great to talk about.
So Radhika, I've already started getting a few questions. The first one is the Momentum 50 an alpha generation strategy? Is it seeking out to generate alpha over the mid-cap TRI 150 index?
Yes, it is. And, the belief is that if you have a smart beta product, or if you have a product that's using momentum, it better beat the mid-cap index in the long term. Otherwise, you might as well do a vanilla mid-cap index. You don't need all this momentum stuff. And we've seen momentum as an approach has worked in India, historically in the long term. And, the data that you showed, Varun, suggests that the fund has meaningful alpha. I mean, you gave the SIP example. I think, we looked at this data together, Varun, and these are, very high numbers. So please don't take them as expectations. This fund had a 7% excess CAGR of SIP returns versus the best performing mid-cap fund. So yes, it is an alpha strategy in the mid-cap space. And what could be very nice is, as an advisor, if you're pitching 3 mid-cap funds, 2 could be active funds with very different styles, and the third could be a momentum fund. The other thing I also really like about the momentum fund is it will have the courage to hold names that your actively managed funds will not. So the portfolio will be very different. They will be good companies, but they will be different companies. Your customer will actually get diversified exposure.
Sure. Radhika, the next question is very relevant, and probably we missed that out. Is that the index will give out values periodically? How much time do we normally take for our fund or our product to replicate the index? Does it take a very long period of time, or do we do it very quickly?
It has to be very quick. I mean, regulations are such that you have to, in equities, you have to replicate the index as it is in exact show. So there's no choice. We do it as we have to, very, very, very quickly, same day.
So there's a follow-up on this one, which probably I will take. This question is, how often does the momentum fund rebalance?
Yeah,
or how often does it do the rebalancing, and what is the period? The rebalancing is done every 6 months. It is basis 31st December and 30th June numbers, and after that we're given a fair period of time for us to rebalance that, and we try and do it as soon as we can. So what you will see is that in about 5-10 days the index is the rebalanced index, or the new weights that are given to us by NSE. We take them into account and fine tune the fund accordingly. Radhika, the next question is a little different one. This is in terms of how is liquidity managed, and do we see a lot of tracking error in a product like this? Because some of the smart beta products have seen significant tracking error over the last 2-3 years. So what do we envisage, or how do we try and manage that tracking error?
Firstly, when we launched both these funds, actually, because they have a mid-cap component, we did a lot of robustness tests and a lot of checks of capacity. There's no sense in launching a product for us also, Varun, if you don't hit a certain set of size. It has to be a few thousand crores and it has to be liquid. And I've understood the challenge that people have had. Now, the good thing in this fund is a few things. One is 150 is a very liquid universe in itself. Midcap 150 is a very liquid universe. Most of those companies have futures and options against them. So that makes them extremely liquid. And the non-F&O portion in this is capped only at 15%. So that is really nice. So that inherently makes the product very liquid. Plus, you've got a 5% cap. So your single stock exposure is not very high. If you look at the tracking difference that this fund has had over, I can say this for large and mid cap, that's been reasonably controlled over the last 1 year. And even this one, I mean, it's been around for a little less than 6 months, has been fine. So we don't foresee any liquidity issues with this one because of how the index is constructed. And this was a concern for us before we launched.
Sure, Radhika. The next question is probably a follow-up on that one, which is what is the relevance of a 5% and 15%? So I think, a better thing would be to just explain the model again, that how does it, work for people?
Yeah, Varun, if you can pull up the slide again, it will just help people as I talk through. So what are you doing? You are looking at the universe of mid-cap funds, that is the next 150 companies in India. In itself, this is a liquid universe. I should tell people, in the old days, people used to believe mid-cap was low corporate governance companies, small companies, etc. These are companies with minimum 2.5 billion to 6 billion in market caps. I mean, a US investor once joked with me that these are not mid-cap companies. So these are just the next 150 companies. So that's what you're looking at. So you start with 150. Now, what you do is you take each company and look at momentum. You look at, is it in form? And how do you define that? Now, in form, as I said, just to repeat, could be one match, could be in form because you played one match well, or you could be in form because you played the last 12 months of matches well. We look at the last 6 months and 12 months so that there's some longevity to the data, and each company gets a score. Once each company gets a score, we pick the top 50 companies, and how much we weight these companies depends on the market cap at that point in time. The other nice thing about the mid-cap index is the market cap range is not so divergent. You're not going from 6 billion to, 30 billion kind of market cap. So companies are fair. There's no way one company can over-dominate the index. Plus, you've got this 5% weight. So you don't have a case like Reliance Industries in a large cap index. There's no harm in that stock, but it tends to be a very large part of the benchmark. Here, no company can be more than 5% of the index. That really helps from a liquidity management point of view.
So, Radhika, what happens when a stock is not performing over a 6 and 12-month period?
So eventually its score will fall. It has a price return. That price return is adjusted for volatility, and that score will fall. So the company will fall out of the index.
Absolutely. So losers will be weeded out and winners will be rewarded.
And it happens pretty quickly because the 6-month one starts to kick in sooner than you think.
Absolutely. Radhika, also, there's a question around the fact that it's got only about 50 stocks. Is that too over concentrated compared to a lot of, actively managed mid-cap funds, which have about, 75, 80, in some cases 90 stocks? Do you think this is just too over concentrated?
I actually think this is perfect. I mean, our own actively managed mid-cap funds and funds, I think 50, 60 stocks is the sweet spot, whether it's for an actively managed fund or a passively managed fund in the mid-cap space. You don't want to run a 20 stock mid-cap problems. You will have issues of concentration. You will have issues of liquidity. I think 50 stocks gives you a nice range of sectoral exposure. You have multiple stocks in each sector, so you don't have single stock risk. You manage liquidity well, and yet you don't have such a large tail that you hold everything.
Cool. There's another question on the same lines, which probably I will take and just say the same things as you have, which is how does the rebalancing happen between performing and non-performing stocks? So clearly, when a stock is not performing, it loses momentum. This is basis their stock price movement. So the fundamental basis of performance is stock price movement. So when a stock's price is not moving in line with the other stocks that are doing better, this stock will actually lose momentum. And as it loses momentum, it will fall out of the index and get replaced by stocks that have done well, and they will catch the momentum and they will enter the index. And basis, how Radhika explained, their rank and their free float market cap. So it is a system of rewarding the winners and weeding out the losers. Moving on, Radhika, there's another question around taxation. How does taxation work for this fund?
So these are both taxed as regular equity funds. Both funds are taxed as regular equity funds. So like any other mutual fund, the tax advantage, as I said, with this fund is, there is churn that happens within the fund. So, if you were, so one of the places, Varun, and I think it's good to mention tax, sometimes people hold a lot of momentum portfolios in things like small cases, right? And customers are holding them directly. Somehow, Varun, you're not visible on screen, only the background is visible. But people hold a lot of these momentum portfolios on small cases. And every time you rebalance, you're paying tax. Here, you're paying tax at the fund level. So a mutual fund construct is very efficient in a strategy where you want to rebalance. Again, in large and mid-cap fund, we already talked about this. If you were an advisor, you would have to do individual rebalances for large and mid-cap. Here, it's collective and the fund does it. So both have their unique tax efficiency there.
There's a tricky question, which is what we had expected as well. So if index funds are so good, why invest in active funds? Why not just invest in index funds?
And let me answer this question with a different twist. You like pizza, Varun? You don't like pizza. You just eat health food. Sorry. Okay. I like pizza. Let's talk about me. Let's not talk about who eats watermelons. I like pizza. I eat at fine dining restaurants and I eat at Pizza Hut. But I eat at them in different circumstances. And that's why I don't like this active versus passive question. Pizza Hut has the value of standardization. It has the value of simplicity. And sometimes when I'm traveling in places like Texas and China and Japan, I don't want to experiment. I want a quick meal and I want to know what I get and I'm cool. When I take my son or when I take my husband out on an anniversary dinner, sometimes Pizza Hut doesn't really cut the trick. I really want a chef's magic at work. So I really think life is, and I hope I answered the question. I really think life is not or, it's and. And you as an advisor and you as a customer have choices. Now, as I said, I'm giving you an example. I'm building my own son's portfolio in a very unique way. I picked up a large and mid-cap index fund for him, which I told you, because I said I need to give him broad-based exposure to the economy. I do like our own small cap fund. I think it has tremendous alpha on the active side, and I want him to have something high risk. I have put an active small cap fund. After speaking to Varun today morning, I'm probably going to add this momentum mid-cap fund. So I've got a vanilla passive fund, I've got a small cap active fund, and I've got a smart beta index fund. It works for him. I think investing has to solve a purpose, and both serve different purposes.
So I would probably look at it as an investor a little differently. How I would look at it is that, there will be time periods that momentum as a strategy will do very, very well. There will be time periods where active fund managers will come into fray. And you need to have a diversification in your portfolio so that, when times are not great for active managers, momentum adds returns to your portfolio and vice versa. So, I think clearly it is not this or that. It is a combination of both. And you as advisors who manage investors and their risk are best equipped to, really, really ascertain that what percentage should be taken into account when you advise clients on this. Radhika, another question around the model itself. And, it's great we're getting so many questions on the model because people do want to understand the model itself. So I think we've created some bit of awareness with people. So the next question is, if a stock is falling, is there a stop loss somewhere in the middle? Do we have a mechanism like that?
No. So the answer is that index funds are rule-based. and there is no deviation from the rules. Now, what will happen is you won't catch, I understand the concern. You won't catch the immediate fall in a stock, Varun, right? So again, back to our batsman example, a batsman's in form, he's doing really well, and then he plays one bad match. You're not going to catch it. You probably give him another, you'll give him another chance. The model will give him a chance in the next match. 2-3 more bad matches, he plays badly, even for 2-3 months, the 6-month score of his will start looking worse, because 6 months is a trailing 6 months period, right? So 3 months would have been good, but 2-3 months he's been playing badly. So the 6-month score will look good. So automatically his score will start falling. Eventually the 6-month score will look horrible, and then the 12-month score will look horrible, and he'll be out. And that is the way life works, right? Nobody penalizes someone for one bad fall. You penalize them for some degree of consistency.
Correct. And that would work on the reverse as well. So if a stock is doing really, really well and continues to outperform, we will not take a call that, the stock is highly overvalued and let us get it out of the portfolio. That's just not going to happen. No. If a stock's doing well, it will continue to be in the portfolio, and more so, the weight of the stock will increase because its momentum score goes up. Moving on, Radhika, there's another question around momentum, which is a little different. It is, if a stock enters momentum, how long does it stay in momentum on an average?
I don't have the data for this. And, there's no right answer. But mid-caps can have a phase of sustained momentum. So there's no reason to believe a stock can't be in momentum for 3-4 years. I mean, think of some of the quality mid-caps that Page Industries, for instance, was a stock that was a Pidilite. It was a stock that was in momentum for many, many years. Vinati Organics, owned by a friend. Again, a stock that was in momentum for many, many years. I think it really depends. It really depends on where you are in the economic cycle, what global catalysts are. It's really, really very hard to say. But stocks can be in momentum for multiple years. It doesn't have to be a very short-term phenomenon.
I would probably take a very commonsensical approach to that, Radhika, which is that if the fundamentals of a stock have started improving, there is no reason for it to just turn out the next month. When fundamentals for companies improve, they stay improved for an elongated period of time. And we think because of that, stocks would stay in momentum for a considerable period of time. But yeah, like Radhika said, we don't have too much data that we can work on and show it across. But point taken, I think we should work on that as well. I'm just going to ask one last question before I let you go, Radhika, which is that if you have to construct an equity portfolio of 100 rupees into equity, what should be the allocation for an investor who's taking 100% equity, has considerable risk on his side? What should be the allocation to the momentum and the large and mid cap fund?
Okay, so I like to divide allocations into buckets. I think in your large flexi kind of allocation, if that's one allocation to your portfolio, large and mid cap can be a great core solution. So you can have a flexi cap fund, an active flexi cap fund plus this kind of fund. You can have a BAF plus this kind of fund. So for that kind of investor, I think this is a very nice one. Could it be 30-40 rupees out of that 100 rupees? Yes, very comfortably. Now, on the mid-cap side, I would probably have this and one more actively managed mid-cap fund. That was the other thing that I had said. So, again, could mid-cap momentum be 20% of your portfolio? Probably. Should it be 50 rupees or 70 rupees of that 100 rupees? That's a little aggressive. And of course, answers are very subjective, and you guys are advisors. So, let me give that disclaimer. But that's the way I think. One is a truly pure core solution. One is a fab mid-cap allocation.
And in terms of SIPs, if somebody wants to start SIPs, where do you think is a better SIP product? A large and mid-cap, or a momentum, or even a small cap or a large cap index fund? Which is a better solution to work with?
Again, a very hard question to answer. As I told you, in my own case, I picked 2 of these funds for my son. It really depends. If you want to take risk, if you have a really long-term time horizon, then I think mid-cap momentum can be your risk allocation. You were the one that told me, and I hate spouting returns, but I was just amazed at the data that I think the SIP CAGR for midcap momentum is something like 24%. So it's astounding stuff, versus an actively managed fund. So I think for a risk-taking investor that works. Large and midcap, I think, works for any kind of investor as an SIP. If you have to do a first SIP for a customer, I think there's no better fund than large and midcap index fund.
Thank you, Radhika. I think this has been very, very insightful. We've got a large audience logged in, and it's increased multifold through the webinar. So I wish to thank all of you from Edelweiss's end, and I would really, really request you to reach out to your advisors from Edelweiss, your relationship managers from Edelweiss. Delve deeper into both of these strategies. We are here to give you more data to support you in terms of any efforts to explain the product further. But on that note, signing off on a Friday evening, have a great evening. And thank you so much, Radhika, for this session.
Have a great evening, and thank you for the insane turnout, guys. I am truly humbled. Thank you so much.
Bye-bye, everyone. Have a great evening.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.